Good afternoon, everyone. We'll just wait for a few more minutes that the participants come in and then we will start. Okay, good afternoon, everyone. I'm Michelle from Capital Markets Malaysia, and I would like to welcome you to our webinar today on PACTA for Investors. The Sustainable Investment Platform was jointly established by the Institutional Investors Council Malaysia and Capital Markets Malaysia. And today we are very pleased to be working with the Rocky Mountain Institute and WWF Malaysia in the delivery of this program on the Paris Agreement Capital Transition Assessment. Before we start, let me run through some housekeeping rules. There is a Q&A box at the bottom of your screen. You may type your questions in the Q&A box. We encourage you to be interactive. The speakers are happy to take any questions from you at any time during the session. The session today will run for 90 minutes, and our presenters from Rocky Mountain Institute are George and Nera, as well as guests. We have a guest speaker, Per Christian from KLP. And now, without further ado, I would like to hand over to Daisy, who is the Associate for PACTA for RMI. Daisy, over to you.
Thank you, Michelle. Good afternoon, everyone. This is, I'm going to share my screen in a second. Yes, so I hope you can see my screen now. So this is the fourth webinar out of a four-part PACTA webinar series that we've been having throughout this year. So the first one was held in April, and it covered the explanation of the PACTA methodology. The second one was a recorded webinar in which we went through the practical implementation of the portfolio alignment methodology. And the third one, and this one being the fourth, are focused on the use cases. So in the third webinar, which was held in September, we have some discussions around the use of PACTA for climate engagement with investees, and also on the strategy design using PACTA results. We had that case study from Sura, which is one of the largest Latin American asset managers, and also some use case study on the CA100 plus engagement framework. For today, we will cover two different and the last use cases on PACTA, which are related to climate risk assessment and climate disclosure and reporting. And we will have a case study on Norway's largest pension company, KLP, about how PACTA fits into this climate analysis. So before we dive into the content of today's webinar, we would like to acknowledge the support of Malaysia UK PAC program. So this is part of one of the working packages, and we are receiving funding from the UK PAC. So we'd like to acknowledge the support. So as Michelle has mentioned, we have the interventions today from George and Naira, who are senior associates at PACTA. And also we have our special guest from KLP, Per Christian Gill-Shammer, who's an ESG analyst, and will talk us through the use of PACTA within their climate analysis. So this is the agenda that we'll cover today. We'll start with an overview of PACTA, very quick overview of the methodology and the different use cases that we've covered throughout the last two webinars. And then we will dive into each one of the use cases that we will cover. At the end, we'll have the intervention on Norway's KLP use of PACTA. And at the end, we'll have some closing remarks and also a dedicated session for Q&A. But as Michelle mentioned, please feel free to drop your questions in the chat or in the Q&A box. but I will also take some questions at the end from the audience and any remaining questions that that we have at the end. So without further introductions, I will give the floor to Naira.
Great, thanks a lot, Daisy. Okay, so as Daisy mentioned, I'm going to present very briefly the PACTA methodology and the use cases that we have already covered some of them, and today we are going to cover the two remaining ones. If we go to the next slide. So as in a brief explanation what the PACTA methodology is. So PACTA is an alignment methodology, so we compare the alignment of financial portfolios to climate scenarios. The methodology relies on physical assets in the real economy. So we have information about where the companies have physical assets in the world. We connect these physical assets to the financial assets that these companies have in the financial market to then check where the alignment of these portfolios against the climate change scenarios. To generate the results, the PACTA results, we need three type of data inputs. So we need the information on physical assets that in this case is provided by asset resolution. We also need financial information that is already embedded in the tool, scenario data, which is also embedded in the online tool that is available in the Transition Monitor platform, and the user uploads a CSV document with 5 columns giving basic information on their portfolios. So basically the user uploads information about the name of the portfolio, the ISIN where they are invested in, the amount that is invested in each one of those ISINs, and then the currency in which those investments were made. With this information in the online tool, we generate some of the metrics that you are seeing on the screen. We already explained some of these metrics in the previous webinar, but basically what we do is first we check the exposure of the portfolio. So we see how much of the portfolio is invested in the PACTA sectors. Then we see the exposure to the technologies in each one of those sectors. So how much is in renewable energy, how much is in oil-based energy. And then we check the alignment. To check the alignment, we have 2 metrics. One that is for the sectors where we have technological pathways defined by the scenario providers. So this is the case for fossil fuels, automotive, and power. And the other metric that we use, the first one is volume trajectory metric. The second one is the emission intensity metric, which is for the sectors where we don't have technological pathways defined, such as steel, cement, or aviation. In the interactive report, there's also a section with company level information. This section aims to inform to the user the companies that are driving the results. So we show the exposure of each one of these companies to the portfolio and which is their technology mix. So how much they are invested in low carbon technologies and how much in high carbon technologies. We have also an additional metric that is the TDM that I'm going to present later on today. If we go to the next slide, these are some of the PACTA use cases. So PACTA can help on climate decision making and strategy. We provide information at a sector level, so it's easier for users to identify in which sectors they need to focus on and then create a climate strategy based on this information. On engagement, because of course, with this company level information, the users can take this information and go and negotiate with their counterparties on how they plan to decarbonize their industries. We can do climate risk assessment. That is the use case that we are going to explain a little bit more today, and climate disclosure and reporting that will be also presented today. Great. So let's go into the first topic, that is the climate risk assessment use case. So in this table that you're seeing on the screen, you are looking at some examples of the transmission channels of climate risks to the classic financial risks. This helps us answering the questions, why do we need to assess climate-related risk? Why? Well, because it affects the whole economy and financial system through different transmission channels. Perhaps some time ago, it was not very clear on how climate change could affect portfolio investment or companies, but right now the world is evidencing how in different regions, climate change is already affecting the populations with floods, cyclones, and wildfires because of extreme temperatures. Of course, this is also affecting companies that are based or have investment in those regions because they are affecting their infrastructure. These events are affecting the infrastructure. And maybe this is a very clear and quite obvious example on how a business gets affected by the materialization of physical risk. But of course, this type of catastrophes affect not just the companies on the offer side, but also on the consumption side or on the demand side. All of these effects will lead to increased exposure in credit risk because of collateral depreciations on the offer side, but also market risk because it will affect the market pricing of companies or listed companies. We will have also more underwriting risk, and it can also cause disruptions in the supply chain, so as operational risk. If we think about transition risk, new regulation can also leave companies with stranded assets if they don't react and adapt quickly to the climate transition. As in the previous example, we will have higher credit risk, market risk, liquidity risk if companies do not adapt. We can see that, for example, right now, the European Parliament already banned the sale of new petrol and diesel cars from 2035. And we will start seeing more of this type of regulation in different sectors. Of course, also on the macro side, we will have some impact of these climate risks. We will see this in the prices, in the capital, some frictions in the labor market because people will have to move from the sectors that are high emitter to low emitter sectors. They will also need new education on the low emitter sectors, and there will be also new consumption patterns. Of course, this will also be transmitted to the financial risk that I mentioned before. In the next slide, there are some examples of climate risk assessment approaches. So today, there are many new different tools in the market to help financial institutions to understand and assess the climate risks. Some of them are portfolio alignment, climate scenario analysis, stress testing, and sensitivity analysis. All these tools that I'm mentioning are different, but they provide complementary information. So there's not really a good or bad approach. What we will always recommend to the financial institutions is to go and test with many tools and find the right one for the use cases. In terms of portfolio alignment, this type of approach allows users to identify gaps between the portfolio and a benchmark. According to the TCFD, and here I quote, portfolio alignment is the action of assessing the net zero transition progress of the individual counterparties and make up a given financial portfolio and determining whether or not at an aggregate level that group of counterparties are collectively Paris aligned. So it should allow the user to identify the gap of the portfolio, but also measure the progress from one year to the other. And it should be taking into consideration the climate performance of the individual counterparties that make up the portfolio. With this type of analysis, the question that is answered is how my portfolio compare with a climate goal and what needs to happen to ensure that they will align in the future. So we need to compare where my portfolio stands as of today, understand where it is today. And in the specific case of PACTA, we analyze where the portfolio will be in 5 years. So we present that gap between today and the following years in each one of the technologies that we analyze. The portfolio alignment tools inform about potential exposure to climate transition risks. So if the portfolio is aligned, means that there is low exposure to transition risk. On the other hand, if the portfolio is misaligned, it implies that there's a higher exposure to future transition risks. If we go to the next slide, we are going to talk right now about the scenario analysis, stress testing, and sensitivity analysis. The scenario analysis is commonly used to estimate changes to a portfolio's value under different scenarios. It is normally used to analyze what will happen under a theoretical worst-case scenario. And this type of approach is conducted in 4 steps. So the first one is identify physical and transition risk scenarios. This task will involve a complete research to understand the assumptions of the scenarios to be used, like the climate goals, the probability of achieving those goals, what is expected to happen in the different sectors and in the different technologies. Then the second step will be linking the impact of scenarios to financial risks. So analyze the impact that those changes can have on my classic financial risk scenarios, like market risk, liquidity risk, etc. The third one will be assessing which companies or sectors can have sensitivity to those types of risks. The fourth one will be like extrapolating the impacts of those sensitivities to calculate an aggregated measure of exposure and potential financial losses. On the other hand, stress testing and sensitivity analysis analyze what potential financial losses will a given portfolio be exposed to in the future and how these might vary under different assumptions. On one hand, the stress testing is uses a specific subset of scenario analysis to evaluate a financial institution's resiliency to economic shocks. There are 2 types of stress testing exercises, the microprudential and macroprudential. The microprudential stress test aims at identifying individual institutions' vulnerabilities, and macroprudential considers the financial sector as a whole. On the sensitivity analysis, this tool is used to evaluate the effect of a specific variable on economic outcomes. To conduct this analysis, one parameter is altered across multiple scenario runs to observe how that dependent parameter will be affected. So these are some of the conventional risk measurements that are used in financial institutions. In principle, these type of metrics, like scenario analysis, stress testing, and sensitivity analysis, could be adapted to assess climate-related financial risk. However, there are some limitations to find historical data, the relationship of climate change to traditional financial risk. There is a range of impact uncertainties and time horizons inconsistencies that make these adaptations a little bit more complex. In the next slide, we are going to talk about the relevance of climate change scenarios for this climate risk assessment. So as we could see, all the assessment of approaches that I presented make use of climate change scenarios. While climate change scenarios don't predict the future, they provide essential information to understand climate change and the pathways to reach specific goals. It is important to take into consideration that climate scenarios are built using a different set of assumptions, and therefore they can propose different course of action to achieve climate targets. So it is important to contrast them before using them for climate risk assessment. What the climate scenario will tell us is how the future will look like for different sectors, which technologies will be deployed, by how much, and also at which speed they should be implemented. In the right side of the screen, you are seeing one of the examples. So of course, scenario providers develop the scenario providers take into account a carbon budget that includes like all the socioeconomic changes and demographic changes that are going to happen in the future. And then they distribute this carbon budget in the different sectors that they are covering in their scenarios. in this example, for example, in year 2022, we see that we have 10 megawatts. In year 2050, in this example, they're assuming we are not going to need 10 megawatts of energy, but 12. But then what they propose is, okay, we need to increase the energy that will be available in the future, but then we won't rely just on brown technology, but we will try to expand the generation that we have in green technologies and mix it with the brown technologies while we finish phasing them out. In the next slide, these are some of the scenarios that we have in PACTA. So we have the World Energy Outlook and the Energy Technology Perspective from the International Energy Agency. We have the Net Zero Asset Owner Alliance scenario that was developed by the Institute for Sustainable Futures, the Global and Climate Outlook developed by the European Commission's Joint Center, and the Forecast Policy scenario developed by IPR. More information on the assumptions of the scenario can be found in our scenario supporting document that is available in the Transition Monitor website, or you can also refer to the website of the scenario providers for more detailed information. In the next slide, I'm going to present the FPS scenario. Why this scenario? Because the next metric that I'm going to explain is based on this scenario, or uses this scenario. So this scenario was developed by the Inevitable Policy Response, IPR, that is a research consortium that aims to prepare institutional investors for the portfolio risk and opportunities associated with a forecast acceleration of policy responses to climate change. IPR believes that governments will be forced to act more decisively than they have until today, and that these new politics will leave financial portfolios exposed to significant transition risks. The forecast policy scenario expects policy announcement to accelerate between 2023 and 2025, given the little progress that has been made until today in reducing CO2 emissions, and because the world is evidencing the increase of unprecedented number of climate-related extreme weather events. One assumption that they also include in their scenario is the longer the delay, the more disorderly, disruptive, and abrupt that the policy will inevitably be. So some of the assumptions that this scenario have is that it will be a deep and rapid change in the energy system. They expect the oil to peak between 2026 and 2028. The thermal coal will be non-existent by 2040. Renewable generation will be approximately half of all electricity in 2030. And then on the transportation or automotive side, they expect ban on the internal combustion engine vehicles. And this will be also supported by decreasing costs of the electric vehicles. So they expect that electric vehicles will be higher in the future. In the next slide, I have an explanation of the PACTA disruption metric. So the transition disruption metric is complementary to the PACTA alignment model. It provides a score of the medium-term potential disruption of the portfolio on the FPS scenario developed by IPR. It measures how much the companies that compose the portfolio have left to do relative to how much time they have left. In this way, it's a progress indicator tracking disruption. The metric creates a quantitative score of the potential disruption in 10 years based on how far the portfolio lags or leads the FPS scenario in the first 5 years. The indicator is available at a technology and a portfolio level, and the higher the metric, the higher the disruption the portfolio will have. The figure in the screen shows an example of the metric. The score of the metric should be interpreted as follows. So if the score is close to zero, the portfolio has fully mitigated the FPS transition disruption model until 2030. If the score is between 0 and 1, the portfolio is ahead or on track to fully mitigate the FPS transition disruption by 2030. There's a managed disruption if the portfolio has a score of 1 to 1.5. So while the portfolio has not fully mitigated the FPS transition disruption by 2030, the residual disruption can be managed. And then if the score is over 1.5, the metrics suggest an increase on managed or high disruption, where, and in this case, the portfolio is lagging a lot the FPS scenario. And if they want to reach the goal of the scenario, the acceleration needs to be much higher than in the first 5 years. If we do like an analogy of this metric with running, and this is just to explain it a little bit more clearly. If we do an analogy with running a race, if we have to run a 10K race in 1 hour, we will get a score of 0 if we run the 10K before the 30 minutes of the race. We will have a score of 1 if I have run 5 kilometers in 30 minutes. Why? Because I'm still on track. If I continue running at the same pace, I will reach my goal at the hour that I have, in the hour I have. But then if I start like running a little bit slower and my score is 1.3, it means that I need to accelerate a little more to reach the target of running the 10K in the hour. But then if I have more than 25%, if I have done less than 25% in the first half an hour, my disruption will be over 1.5. And it means that I need to run faster if I want to finish in the 30 minutes that I have left. In the next slide, we have an example where the European Central Bank is setting PACTA amongst other methodologies, and it's not exhaustive list of examples of tasks performed by the risk management function in the work in the talk report. Of course, the task is portfolio alignment assessment based on the PACTA methodology. I get to go to the next slide. Perfect. I pass the word to my colleague George, who will walk you through the third use case of PACTA, climate disclosure.
Great, thank you very much, Naira. So today I'm just going to quickly take you through the kind of fourth and final use case around how PACTA can be used in the disclosure and reporting use case. So with that, if you go to the next slide, please. Thank you. So just quickly on this slide, I want to give some kind of potential reasons as to why financial institutions are undertaking climate disclosure reporting, and to suggest some examples as to different frameworks out there and kind of forthcoming regulation. Of course, this is very much jurisdictionally based, and of course, this is a very much a non-extensive list, just some kind of examples to think about here. So the first kind of broad reason as to why financial institutions would be doing climate disclosure reporting is kind of from regulatory reasons or regulatory pressure. Two kind of brief examples here, the SFDR and the EU taxonomy regulation. The second kind of broad reason as to why financial institutions are starting to undertake climate disclosure reporting is to kind of communicate on their risks and opportunities that the transition to the low carbon economy is presenting. This is very much aligned with the thinking and the theory of change behind the Task Force for Climate-Related Financial Disclosure, also known as the TCFD. And kind of the final broad grouping here is around sustainability reports. So how financial institutions can increase their transparency and hence accountability and communicate to a broader range of stakeholders on their current and forward-looking climate positioning. So with that, if we just move to the next slide, we can dig a little deeper into each of these examples and to see how PACTA can be a useful tool in helping contribute to these respective climate reporting and disclosures. So the first thing to say in its regulatory use case is that PACTA in itself is never likely to directly meet the recommendations or the requirements coming from the regulator, but rather it's useful in understanding and contributing to that. So we'll note this in the case of the TCFD in the next slide, but it's worthwhile noting that the TCFD has in fact become a regulatory requirement for some financial institutions within the UK. Of course, again, that is jurisdictionally based. So then if we look at another recent example, and this is coming from the Swiss government, who have issued, and it's currently voluntary, a Swiss climate scores. So that's what you can see on the right-hand side here. So it's essentially a request from financial institutions to set best practice by disclosing their different kind of climate exposures, or you can think of these as different climate indicators. So whereas PACTA in itself does not answer all of these, it can be used as an input to output part of these points. So if we go through this case by case, you can see in the red boxes, the carbon footprint can be calculated off the back of your PACTA results with the use of some emission factor models. And this is contained within the interactive report that we showed in the second webinar. The second element on the top right-hand side is to show the exposure to fossil fuel activities. Again, this is a very integral part to what the PACTA methodology does, indeed looking down at the individual asset level through the respective companies. So we can contribute towards that. And then the final part here is the global warming alignment. So whereas PACTA in itself doesn't naturally do this at the aggregated level, i.e. the portfolio level, there are methodologies that you can use to aggregate your sectoral alignment scores coming from PACTA up to this portfolio level. Of course, that's limited to the PACTA sectors. And when we do this with PACTA, we will not show you a score based on a temperature rise, but rather based on an A to F rating derived from the different scenarios to which you're aligned. But you can start to see how with some additional methodologies, you can get to similar data points to help understanding and contributing to these forthcoming regulatory requirements. So it's just a quick example from the kind of Swiss use case here. And with that, if we move to the next slide. And now if we take a little bit of a deeper look into the TCFD, so we of course have, which I'm sure everyone's quite familiar with, the different core elements of disclosure proposed by the TCFD recommendations. So the first element is to disclose and report on your governance. So when we run PACTA in what we call these coordinated projects, so PACTA COP projects, we're currently not doing this in Malaysia, but for your reference, we're doing this across Europe at the moment with different jurisdictions. What we do as part of this is we include a survey. So that survey asks questions about how the financial institutions are engaging. So similar to the previous webinar, different climate initiatives that they're involved with and their different commitments. This can therefore help a financial institution in disclosing their governance as relates to climate topics. Second element here is around the strategy. So again, as presented in the previous webinar, we can start to think about how PACTA as a portfolio alignment and scenario analysis methodology and tool can be used to inform our climate strategy. The third element here is around disclosing on risk management. And indeed, the PACTA data points can be used in the sort of tools that Naira just covered, thinking about climate stress testing and sensitivity analysis. So the 2 Degrees Investing Initiative, think tank up for Europe that indeed came up with the PACTA methodology, has put a lot of thought into using the PACTA data outputs as their own inputs into climate stress testing and sensitivity analysis tools. I believe you can follow up on that on their website as well. Then the final point here is perhaps the most obvious one, and that's how PACTA can be used to disclose on the metrics and targets part of the TCFD. So this comes in the form of the volume trajectory, the technology mix metrics that I hope we're all getting a bit more familiar with as a PACTA output. That's a quick way in which it can be used within the TCFD. And if we move to the next slide, we can also look at how PACTA can be useful in terms of communicating to a broader group of stakeholders in the case of sustainability reports. And I seem to have lost my slides, but if you bear with me, I can get them back. Okay, yeah, sorry about that. So with different sustainability reports, I give brief examples here. Fortunately, we don't have an example from an investor as of yet. However, we can take some examples from different financial institutions in the form of banks. So a key case in your region is from CIMB, who include their PACTA results within their sustainability report, Future Forward report. The second example here would be from ING within their Terra report. So it's a very detailed climate report out of the Dutch bank ING. The third one from a French bank, BNP Paribas, use the PACTA inputs as within their climate analytics and alignment report. So with all of these cases, this is not an extensive list. There are indeed other financial institutions doing this. And it's also worth mentioning that PACTA isn't used. It's kind of added to. So ING use PACTA in their own way, BNP Paribas use PACTA in their own way, and they present their results on kind of a specific case-by-case basis. So just giving you some examples as how it can be used within sustainability reporting. So if that moves to the next slide. Great, thank you. So here I'd like to take you through how kind of the reasons as to why PACTA is a good starting point when it comes to reporting and disclosure. So one of the core tenets with PACTA is that it's a sectoral approach. So we believe that this can help you communicate accurately in a disaggregated way your respective climate alignments per sector. So we can demonstrate our risks and opportunities per sector. And we believe that when you do perform this aggregation to the portfolio level, this can lead to details within respective risk and opportunity profiles being a bit obscured or distorted. That being said, there are of course other use cases that merit from doing this aggregated reporting, as we presented from the Swiss scorecard in the previous slides. So with that, PACTA is of course limited in that we only cover the PACTA sectors. So are of course other sectors that fall outside of the PACTA scope that are important when it comes to climate risks and opportunities. The second kind of limitation to this approach as well is the PACTA approach at the sectoral level can be tricky to communicate to specific audiences. So whereas it might be intuitive to a more technical audience, it might not be the case to kind of broader, less technical audience as well, to which other metrics might lend themselves better. So different kind of use cases, different ways in which you communicate this. The second broad way in which why PACTA is good for reporting and disclosure is it's inherently forward-looking. So this allows us to communicate what the future will look like in terms of climate alignment, assuming all else remains constant within our portfolio. This again has its own limitation and that doesn't really show us our alignment as of today, to which other methodologies might be more useful here. Then finally, why is PACTA a good approach here is about it being a free and open source methodology and tool. This means that it doesn't require any kind of commitments. So you're not bound by the results of PACTA in any way. So you can use it and you don't have to hold yourselves accountable. We hope that you will use it as a tool for accountability, but it is not a target setting initiative. It's not a constrained kind of initiative whereby you have to be fixed to these kind of requirements. Related to this, it's not a black box, meaning that your different stakeholders can look inside the hood of the tool and understand the methodology themselves. The third part here is that the scenarios we use are based on internationally recognized third parties. So the benchmarks to which you're comparing to are again not black boxes, but rather internationally recognized scenarios, the ones that Naira touched on briefly at the beginning. And then if we move to the next slide, we can look at the kind of data points within PACTA and again, why these data points contribute to PACTA being good from a kind of reporting and disclosure point of view. I'd also like to highlight with this slide the source at the bottom, which is around decision useful data points produced by the Centre for Climate Aligned Finance from the Rocky Mountain Institute. So with that, PACTA is useful in that it provides comparable data points. So PACTA is based on these production values, as we've been discussing throughout this webinar series, which means it doesn't suffer from potential inconsistencies in the different reporting structures of different carbon accounting methodologies. So sometimes when we have voluntary ones and compulsory ones, although efforts are being made to improve this, we still have certain inconsistencies with different accounting methodologies when it comes to carbon amounting and the boundaries being set. By sticking to one consistent data point, it's comparable. We believe that production values helps it. Related to this point is that PACTA doesn't include estimates or proxies to fill data gaps. It is coming from one data source. Second broad point here is that these data points are consistent year on year. So again, this forward-looking production value is not, when we compare our analysis year by year, it's not affected by kind of price market fluctuations, which it could be if we're using a denominator based on financial variable. So we kind of negate that issue by using these forward-looking production values. The third kind of point here is partly this forward-looking element again. So as PACTA is forward-looking, it helps us to communicate where it helps us communicate on our risk and where it's helpful to the stakeholders to understand what the alignment needs to be and what currently the portfolio is on a trajectory for. So I believe that's my last slide. We go to the next slide. Great. So with that, I'd like to hand over to Per Christian, and who can take you through kind of how KLP have been using PACTA in their journey. And again, a massive thank you for KLP to join us today to take you through their kind of user journey in PACTA. So I'll stop there and hand over. Thank you very much.
Good afternoon, everyone. Could someone just give me a heads up that you're seeing and hearing me okay?
Yes.
Great. So just give me a second so I can share my slides here. So, and if someone could just give me a heads up that they're seeing my slides as well.
Working as well.
Okay, good afternoon, everyone. Thank you so much. It is such a pleasure to be invited. My name is Per Christian Gillesammer. I work as an ESG analyst at KLP. I thought I would give you an easy start, just to say with where and who KLP are. Then I would like to introduce you to our revolutionary net zero target, and then just go into the really nitty-gritty details of how we incorporate PACTA into our net zero target. So in case someone's wondering where is Norway, we are on the northwest side of Europe. It is a land of mountains and fjords, sharing land borders with Sweden, Finland, and Russia. We have the world's largest sovereign wealth fund, but are majorly dependent on fishing and oil and gas. So that basically describes Norway in a few simple words. And in case anyone is wondering, yes, it is snowing outside this morning. It is 8:45 in Norway right now. So KLP, we were established by the municipalities in Norway in 1949 to secure pensions within a strong community. As of today, we are the largest pension company in Norway and expert on public sector occupational pensions. We manage about $91 billion in pension assets for Norwegian local government and healthcare sector. And we are owned by municipalities, companies affiliated to the public sector, and health enterprises. Now, our owners are also our customers, and that sets value, and their values and expectations, they set guidance for how KLP should do, what KLP should do, and how we invest. As you see, the health enterprises being our owners, that means that led to us excluding tobacco already back in 1998, which it basically sets the ground for what we should do and how we invest. So, of course, climate is on everyone's agenda. So, a little over a year ago, the board agreed to our net zero target, which we called the road to Paris. It is a kind of a new approach to net zero for our financial institutions. A couple of colleagues and me created. We are very proud of it. I'm going to take you through it because you need to understand our approach in order to understand how we're incorporating PACTA methodology into it. If you would like to read even more, I've included a link to our webpage at klp.no/en/climate. You can read our, I think it's 8 pages long report on how we've set that target. So when we started to set our net zero target, we agreed that, okay, IPCC's global carbon emissions pathway is the foundation for our net zero target. But that just led to a lot of questions, i.e., what does this mean, basically? How do we know if an oil company is aligned with this pathway? How about an IT company? Can we use taxonomy data, especially from the EU? But that would be a good idea, but it's not here yet. And what about investments which we don't know so much about yet, at least from a climate perspective? And that is following those questions, we introduced what we called the Paris alignment percentage. It is kind of a bit of a funny story in that we were sitting during the pandemic, sitting at our home office one late afternoon, a bit tired, a bit grumpy, and it's like, okay, we need to call it something, and we would just call it Paris alignment percentage. It's a silly name. We'll change it later. We never found anything better, so it's stuck. So that's why it's called the Paris alignment percentage. But it's basically saying it is putting sectors and companies and seeing how aligned are they from a scale from 0 to 100. 0 means that it's moving in the wrong direction or there is no basis for evaluation, while 100% is net zero or doing more than its share towards net zero in 2050. And the Paris alignment percentage kind of all values between 0 and 100%. And it works by we use an investments or sectors Paris alignment percentage. We multiply it by the investment value, and we get the value of the Paris aligned investment. The sum of Paris aligned investment values divided by the sum of investment portfolio values equals KLP's Paris alignment. It is around 42% as we speak. So what this enables us to do is to have one indicator which facilitates different approaches to measuring different sectors with regards to alignment. It is able to adapt to new and improved methods and data. You're not stuck with some weighted average carbon intensity number which you aren't completely comfortable with. It has a sector by sector focus. It should incentivize decarbonizing companies and not divesting from the sectors where decarbonization is the most needed. It also punishes lack of data and incentivizes more and better climate data. So I'm going to go into even more details of how we should do it. We basically divided our investments into 4 major categories. We have those which we called green or aligned investments. These are investments that are aligned with the goals in the Paris Agreement. They are today net zero or nearly net zero emissions. Think a renewable energy producer is 100% Paris aligned. It is an aligned investment. Then we have high emission sectors. These are emissions intensive sectors where KLP can use scientifically based pathways to measure alignment. And this is where PACTA comes into play. I'll speak even more about that further on. For these sectors, we are somewhere between 0 and 100%. I'll have actual numbers for you a bit later. We have remaining investments. It is a very large part of our portfolio, but it is where sectors where we don't have these scientifically based pathways, but where we can use best-in-class approaches to measure alignment. As of today, we're using a reduction in carbon intensity, as in revenues, emissions over revenues, and implied temperature rise, a calculator created by the CDP and WWF. And these investments are all somewhere, these sectors or investments are all between 0 and 100% Paris aligned. And then we have a very key point of our alignment method. It is the no data category. For those investments you have where we don't have the necessary carbon data yet, you don't have maybe the methodology of how to include it yet, in these cases, we penalize these investments with a worst case result, 0% Paris aligned. So all these groups in themselves, they provide the input for KLP's total Paris alignment percentage. And as I mentioned earlier, the high emission sector, the second category here, is where the PACTA methodology comes into play. And I'd like to just start off with some words on how we use it, because the previous speakers have talked about it as well. In that, our main focus of using PACTA up until now has been from a climate responsibility perspective, in a climate alignment perspective. That means we've basically been very strict in saying this isn't climate risk, this is climate alignment. But as you mature, and as I've seen Naira and saying, is that you are able to, even though we use it for alignment, there is definitive value in the climate risk perspective as well. So we'll definitely be using it for that going forward. We aren't there yet, but as of now, we've been using it from an alignment perspective. But then again, taking climate responsibility is basically handling climate risk. So it's never as easy to as black and white as you'd like to think. So let's head deep into the nitty-gritty details here. So I'd like to start off with the sectoral decarbonization approach, and just to take you through it. So how we create a Paris alignment percentage using the sectoral decarbonization approach. So this is just an example. We have these black dots here are companies and with their relative carbon intensities. So PACTA's data provider, Asset Resolution, has data on companies' carbon intensity. So there could be some, and when I say carbon intensity with regards to the sectoral decarbonization approach, I mean emissions over some production, e.g. tons CO2 equivalents over tons of steel. And then we use these carbon emissions and their weights in our portfolio by the market value to find KLP's weighted average carbon intensity for that sector, represented by this green dot here. And then the scenarios provide the pathway which describes where the intensity should be in a given year. And finally, what we would like to do is to have a forward-looking approach to this. The PACTA's data provider Asset Resolution isn't quite there yet. This is a work in progress, but this is where we would like to be. We would like to go 5 years ahead and see, okay, where are we on a forward-looking approach to see, to incorporate alignment with regards to planned production. But we're not there yet, so we're stuck with today's situation. So this is basically what our steel portfolio looks like right now. We have investments in over 7,000 companies across the world. So there are quite a few. So what we're doing here is the carbon intensity is, let's say, tons of CO2 over tons of steel. And you can see that we're using the distance from the pathway to our portfolio and seeing, okay, how aligned are we? So you can see we take the scenario intensity and divide it by KLP's intensity. That's 2.05 over 1.33 is 157.57%. We cap all Paris alignment percentages to 100% at max and at least 0%. Which means and that is a key component here, because we don't want sectors to be able to justify other sectors. We don't want IT companies to be able to compensate for oil companies. That isn't something we want to do. So for a sector by sector basis, we always cap these Paris alignment percentages. So what is interesting here is that I know Singapore has its own taxonomy. I know Malaysia has its own EU taxonomy, and the EU taxonomy has very specific guidance with regards to these as well. And you can see how difficult it is to be aligned per the EU taxonomy. You can see the numbers here are. Well, hot metal is quite high. It is basically our average intensity as of today. But for other forms of steel production, you can see that these are quite low, pretty far out in the pathway. So my next point, the market share approach, where we have forward-looking, where we have actually technology pathways for different sectors. So how we do this is that asset resolution gives us data on companies' current and planned production of some technology. Say the black and red lines here represent different technologies and different planned production of that technology. And then using the current production and scenario pathways, we create these light red and light gray scenario productions. Say, okay, this company which produces these technologies, how much should they produce of that technology in year 2026? Here we are able to use this forward-looking approach, as I discussed, would want to do with the sectoral decarbonization approach earlier. And then we create versions of these for each company in their own sectors and weighted by the company's market value and KLP's portfolio to create a version representing KLP. Now, and then we are able to just look at, okay, so where is the planned production for a given technology and where is the scenario production? We're able to compare them. So with regards to green technologies, the production should be above the scenario for that given technology, and the planned production should be below the scenario for fossil-based technologies or brown technologies. So this is basically what our oil and gas portfolio looks like. There is too much planned oil production with just about right with regards to gas. So you can see we take into account the distance with regards to plant production. This is the y-axis here is gigajoules of production of oil and gas. The black is the planned production for oil. The gray is the oil scenario, and you can see, you can compare, and you see that with regards to it is the planned production is far above the scenario. So we have a Paris alignment percentage of the oil sector of 76.3%, And with regards to gas, you can see that the planned production is slightly below the gas scenario, so it is 100.1%, 101.7%. And then there's some math down here to just see how, okay, so we were able to create like basically a percentage for that sector. So using these methodologies, we're able to just say, okay, these sectors with their corresponding methods, you can see that we are aligned with regards to steel, airlines, and cement, and we are a bit away under 100% with regards to oil and gas and energy production and car manufacturers. But what is so good about this is that not only do these numbers give us information on which sectors we need to work on, they also give us information on which companies we should focus on, which have the farthest distance from, with regards to the market share approach, how farthest distance from where they should be, which are the most effective airlines and steel companies. So we're able to not only just potentially evolve our portfolio to be more aligned, to make sure that we're investing in those who are aligning, but we're also able to talk to them about this. You say, okay, we can go to an oil company and say, let's go based on what the IAEA or some other sector or other scenario provider says, you need to cut your planned production, or you need to change how you create steel based on, or change your mix basically. So I would like to end with some food for thought and consideration with using PACTA methodology. And one of the key I'm not sure if I want to call it an issue, but it is definitely something everybody should be aware of. And maybe Naira and the others already spoken about this as well. But when you are using the technology pathways in using the market share approach, it is not enough that the fully renewable energy producer or a fully green car producer is it is not that it's just only producing clean energy or clean cars or electrified cars. There is also in these scenarios an expectation that they need to do more. So this is for a very known car manufacturer creating only fully electric cars. And note that the scenario expects that car producer to create more cars going forward of the same. It isn't enough that you're only producing green cars, you need to even produce more to stay aligned. And this is something Naira was spoke of as well, and this is a large this is an issue because there isn't just one path to net zero. There isn't just one scenario. There are multiples, and there are good reasons for why there are multiple scenarios. You have the IEA, you have the OECM, you have the NGFS, and there are multiple variations over technology optimism, carbon capture and sequestration, differentiated responsibilities, carbon pricing. Is it based on is it coming from a risk perspective or an alignment perspective? The intention of the scenario, and that creates very different expectations for different sectors. So you can see here that this is basically what the OECM in black and IEA expects in red, expects the demand of gas to be in 2050 compared to today's numbers. So the OECM says that, okay, we expect future production to demand of gas to be 8% of today's numbers, while the IEA says we expect it to be 44% of today's numbers, so drop in 92 and 56% respectively. And that That means there are, if I go to an oil and gas company using the OECM scenario and says, oh, there's barely any room for a gas production in 2050, you need to be able to take that into account. There's just 8% of what you're producing today will be demanded by in 2050. And then another investor goes to that same company and says, no, in 2050, we're going to you still be at 44% of what you're today. And that is a large issue. And that is, and we discussed this with quite a few other investors in Norway, and they said that, yeah, we are aware of the problem. We don't know what to do either. So what we figured is that we're just going to choose one. And we're going to choose the IEA Net Zero 2050 scenario for alignment considerations. This is because we chose this one because it is consistent across sectors, across the financial sector. The European Banking Authority demands use of the IEA Net Zero 2050. It is updated yearly. It covers the most important sectors, and it has a good scientifically based foundation, and it is based on alignment intentions. And Naira said, I almost want to disagree with Naira here, in that she said that you need to compare these before you choose. And I almost want to say completely the opposite. I want you to say, just use what everybody else is using, use the IEA Net Zero 2050 for alignment purposes. If we're going to need the push from the financial sector that the world needs to align, then we need to speak with one voice. And so cooperation on scenarios is very important, so that we're not disagreeing with each other on something we should be definitely agreeing on. But I may be over dramatic here, but again, no matter what scenarios you choose, there is definitely going to be the same general direction. All arrows point in the same direction. We need decarbonization. So I'm nearing my end here. If you have input, if you have comments, if you have ideas, if you want to know more, if you're not tired of hearing my voice, please reach out on my mail or on LinkedIn. I'm always happy to discuss. Please steal our method for net zero alignment for our financial institutions. We're very transparent about it because we want others to be inspired by it and use our same approach, because we need decarbonization, not just divesting from sectors needing decarbonization. That was all I had, Michelle. So I don't know if you want to, if there are any questions, or if you want to, if you want me to expand on something.
Thank you very much, Christian, for your intervention. I will share my screen again just to do some closing remarks, and then we'll have some time for the Q&A. So I guess you are seeing my screen. Yes, George, please feel free to jump
absolutely.
in.
Thanks, Daisy, and thanks very much, Christian, for that really insightful knowledge. That's really, really great, and thanks for sharing it today. So yeah, just some quick kind of closing remarks, and just want to reiterate the point that's been made throughout, and indeed that PACTA is an approach to measuring kind of climate portfolio alignment. It is then an approach that's kind of predicated on this decision useful, or what we perceive to be decision useful data points. The intention here is to support financial institutions in better understanding their climate change risks and opportunities, so as to inform their decision making and their strategy processes and to do so in such a way so as to steer investments towards decarbonisation in the real economy. So it really is just an approach to measuring portfolio alignment, but we really hope that it's one, and we hope that we've demonstrated this through the different use cases and the different case studies as well, as to how this can be useful within different functions of the respective financial institutions. So then the next point here is indeed that it's a free and open source methodology supporting toolkit. So you can indeed go back to the second webinar, go online at Transition Monitor website and produce your own results here as well. The case studies presented here from Pierre Christian and from Sura the other day are very much just two examples as to how they've used, how these two financial institutions have been using PACTA. And I think we've seen some really, really detailed and great insight into how this can be taken into practical actions as well. We've also highlighted limitations as well. And I think that brings us on nicely to the next point, that PACTA is very much open source. We're very much open to being transparent about these limitations so that we can continue to iterate, improve, and expand the PACTA scope. So very much encourage everyone to reach out if you have further questions, ideas, doubts, queries, anything, so that we can continue improving this public good for all. Then finally, just to wrap up with this webinar series, as a brief reminder that these are all available on the Sustainable Investment Platform's website on their events page, and they're all pre-recorded. So the first webinar, we went through PACTA as a methodology, explaining the approach behind this. The second one was around practical implementation. So you can follow the step-by-step guide there to generate your own interactive report. The third one then was starting to look into these use cases. So the third webinar was on designing investment strategies and informing investor engagements, use cases from Sura, the Latin American investment manager, and indeed from the CA100 Plus case study as well. And finally, the webinar we've just given today, again looking into different use cases, primarily on the risk assessment use case presented by Naira, then by myself on kind of thinking about disclosure and reporting, and then that excellent case study from KLP as well. So with that, I'd like to just do a massive thank you again to Pierre Christian presented from KLP. Really, really amazing to see all your user journey there. Massive thank you to our funders, UK PACT, Malaysia program, of course, to our partners in this, WWF Malaysia, and a massive thank you for hosting us to the Sustainable Investment Platform as well, and Capital Markets Malaysia as well. So thank you all so much. We'll open up the floor for questions here. And again, we'll share our contact details and really encourage everyone to continue this conversation beyond this webinar series as well. Thank you very much. We'll open the floor to questions.
All right. So while we wait a couple of minutes, in case there are some open questions or if anybody wants to jump in directly. So if I may, we've got already a couple of questions that I would like to start with. So again, thanks a lot, Per Christian, for sharing the journey of PACTA throughout KLP's climate analysis and studies. During your intervention, you mentioned that PACTA is being used with this like climate responsibility focus, and you briefly mentioned about maybe some future developments or some future plans for PACTA. So if you can just walk us through what are the plans for PACTA, for using PACTA within the KLP's climate assessments? Just a few words on that.
Yeah, thank you. So the first step is basically more sectors, cover more investments, more scientific approaches to measuring alignment. Especially shipping would be very very interesting to cover from a Norwegian perspective, a very important sector for us. What we haven't incorporated yet, I know that in the PACTA methodology there is some method for it, is to include some company-specific carbon budgets. So you're able to penalize from an alignment perspective those who emit too much emissions today and next year, but then they're starting to align. So they need to catch up, basically, and we need to ensure that the debt they own is incorporated from a climate budget perspective, if that makes sense.
All right. Yeah. So you mentioned also, apart from shipping being one of the main sectors for Norway, I guess oil and gas, it's also, and you also briefly mentioned it at the beginning of the interaction, about some of those key characteristics of Norway market and sectors. And with the current circumstances, like global circumstances, like the war in Ukraine, we all seen that this has considerably affected the oil and gas sector. And just wanted to hear your opinion and your thoughts. Like, do you think that those global circumstances will affect the alignment calculations that you have currently and in your assessments?
This is such a huge personal problem for me because as you may know, energy prices in Europe are pretty crazy as of now because there is no import from Russia. And being in a situation where Europe, as basically a continent, is highly dependent on Norwegian oil and gas, and then just to make it through the winter, and then my alignment calculations say I need to go to Equinor and say, no, you need to produce less oil and gas going forward from a climate perspective. That is sort of a personal problem for me, because from a from a ethical perspective, maybe that's not the best idea, but from a climate perspective, that is what is required. And for climate alignment considerations, it shouldn't affect it. Basically, it is the carbon budget is the carbon budget, and global heating continues whether or not we have a war in Europe or not. It is a very very tough lesson to learn, but it is something we need to be aware of. But I would also like to highlight that we are measuring oil and gas companies based on how much they produce of oil and gas. And we are not able as of yet to capture their transition process. If an oil and gas company is transitioning into renewables, say ocean-based wind, we're not able to capture that process, which means we are basically using all alignment considerations will always be approximations of the truth based on some simple criteria. So there will always be this issue of, are you basically capturing the entire truth with regards to if a company is aligned or not? But that I don't think we'll ever be able to get to the end with regards to that problem.
Yeah, totally understood.
Mm.
So I don't know if we have any remaining questions, just maybe to give it a few more minutes. So Naira, you presented the TDM, which is part of the Transition Monitor platform, right? If you could just say some few words, just to remind the participants about how they can be able to generate these type of results. Just few words on the platform and how they can log in and use it.
Sure. So yes, the transition disruption metric is part of the interactive reports that can be accessed in the Transition Monitor platform. New users just should log in and create an account. They will receive an email to confirm that the email is the right one to create the account. And then when you go to the platform and you're already logged in, you have one mock portfolio, so you can also try with a mock portfolio to generate a PACTA result and see how it looks like. We have also a section where we explain all the requirements of the CSV file, so the tool can read the information that is included in the file. The report takes around less than 30 minutes to generate, like it depends on the size of the portfolio, of course, and the users can generate more than one, or well, analyze more than one portfolio in the same file. So when they upload the file, they just need to differentiate like the different funds they have with the name, in the column that they include the name, and then the tool will generate one report for each one of the portfolios that they included in the file. There's also an option where they can aggregate all of these results and have just one PACTA result for the financial institution. Regarding the TDM metric, it is embedded in the tool. It's complementary to the other PACTA results, since it provides like a view on how the portfolio will look like, or not how the portfolio will look like, but how it will be impacted after the 5 years that we normally analyze in PACTA. So it's a very interesting metric, very useful as well for risk management. Of course, I invite all the people here to go give a look to that metric and provide us the feedback, so we can also check what the impact of our metrics are on financial institutions and how they are perceived by them.
Perfect. Thanks a lot. We have one additional question on the Q&A box. I don't know, George, if you'd like, or Per Christian, if you'd like to also give your opinion on this. So how to manage greenwashing issues, especially for oil and gas companies when using the PACTA methodology? If either you wants to say a few words on that.
So I can start, and maybe George, if you'd like to comment as well. You are measuring oil and gas companies based on their most emission intensive activity, and how much they produce of oil and gas is how much they produce of oil and gas, period. And if you produce a million gigajoules of oil and gas, then you're producing that, and you're not able to greenwash that away by saying that we're the most carbon intensive friendly producer of oil and gas in the world. You are measuring what is the key criteria for measuring oil and gas companies, how much they produce of oil and gas. So to summarize, I'm not that worried with regards to oil and gas companies. You are using the PACTA methodology, you are basically ignoring all these, you're able to ignore a lot of these greenwashing techniques that oil and gas companies use. So yeah, I'm not that worried with regards to that specific issue. I don't know if you would like to agree or disagree, George.
Yeah, exactly. I think as you point out, the kind of PACTA methodology is inherently kind of anti-greenwashing in this kind of respect, but also, to be candid and to highlight a limitation that indeed Pierre Christian points out as well, is to date the PACTA methodology in the oil and gas sector is not necessarily conducive to assisting those oil and gas companies with their transition. It can help to show what is required for this main indicator being barrels of oil and gas, but doesn't speak too much to the internal transition plans that those companies themselves might have. Those transition plans can very much be a source for greenwashing, as we've kind of just alluded to just now. But I think we can do better as the PACTA methodology providers in providing what is more around transition plans for corporates as well. And indeed, as we talk about expanding the scope and improving the methodology, this is very much a hot topic, and we're currently engaging a group of experts on new oil and gas metrics, and we expect in the next year to be bringing out a new set of PACTA metrics in the oil and gas sector, which will look at the scope 1 and 2 emissions, as improvements do need to be made here, whilst capping for the absolute, so indeed the scope 3 to which PACTA is proxy for. So combining different elements there, whilst also looking at the other activities and potential business transition plans of oil and gas companies. So that'll be a factor. And then also is including the asset transfer of different oil and gas companies. So whether or not they're greening their portfolio based on selling assets or buying new assets, but rather if there is true decarbonisation in the real economy, i.e. the winding down of such assets. So all of these different approaches we intend to encapsulate with this forthcoming oil and gas work as well. So I hope that gives you a bit of insight into some of the stuff we have in the pipeline. And yeah, I think I'll leave it there. Thanks.
Great, thanks a lot. So with that, I don't see any more questions. So I guess we call finish it here. So thanks again. Thank you for your participation. Thank you again, Christian, for your input. Thank you, Naira and George, also for your interventions. Please reach out to us for any questions or comments. And yeah, also you have the possibility to log in into the Transition Monitor platform to do the PACTA assessment based on your portfolios. But please do not hesitate to contact us in case you have additional questions or comments. So thank you again. Thanks, Michelle, for your support also. And I think we can end it here.
Thank you, everyone.
Thanks a lot. Have a good day.
Thank you so much, everyone. Have a good day.
Thank you.
Thank you. Bye-bye.